Okay, thanks, Barry. Tim?
Thank you. When considering the state of not just bankruptcy, but this bailout economy, I think it's proper to focus on the procedural integrity, not just of the courts, but of the policies adopted by elected branches. I appreciate the concerns about the General Motors bankruptcy, and yesterday was on a panel in which that was somewhat the focus of one of the presenters. I find it more interesting to focus on the bankruptcy of Lehman Brothers and the significance of allowing Lehman to go into bankruptcy, but then the decision not to do the same with AIG, with the American Insurance Group, which led to a train of events where not billions, but trillions of dollars obviously have been spent. There's been some attention given to the fact that banks are paying back TARP, Bank of America and Citigroup and others. There's been far less attention on what has helped them get to the point of paying back TARP, and that's the Federal Reserve's balance sheet. It's been reported that the Fed has spent at least $1.5 trillion in the last year purchasing toxic assets. These are not arm's length transactions as far as we know. There's not a lot of scrutiny on the terms of the purchases by the Fed of those assets from banks, hedge funds, financial institutions of all kinds. In addition to purchasing $1.5+ trillion of toxic assets, the Fed has apparently given loans to the same cohort of financial institutions of more than $1.5 trillion in loans, where toxic assets have been pledged as collateral. So that's a $3 trillion infusion. One wonders what the effect of all of that spending is on moral hazard, the state of the economy today, the state of the economy in the future. Larry had posed some questions to us by email, which I thought were great questions, and I wanted to use those questions as a way to move the discussion forward. He had asked, he said, assuming that there's some basis for government intervention outside of bankruptcy, what are the potential costs of such actions? And again, just to reiterate, I think it's very uncertain what the costs are for bailing out the way the system has devolved into such a bailout economy. It's reported that something like 400 banks are on the FDIC's troubled bank list, which highlights that there is a differential treatment going on. There is what certainly seems to be a cartel like reality, where just a few large financial institutions, JP Morgan, Citigroup, Bank of America, Goldman Sachs, and a few other favored financial institutions seem to be making out well, posting large earnings, paying large bonuses, having very high return on equity, without scrutiny as to what has gone into those earnings. Again, I'd suggest that it's these very opaque transactions with the Federal Reserve. And other financial institutions that might not be so politically connected and fortunate go under, which just increases the market share of the favored institutions. Larry had asked, what are the politics driving the government bailouts? And it should be somewhat obvious that the favored few financial institutions are very politically connected. We see this with the revolving door that has been going on for years now between Goldman Sachs and the Treasury Department. President Obama recently on 60 Minutes denounced the so-called fat cat bankers, and he had three major complaints about these bankers. One is that they're paying themselves large bonuses. The second is that they have not been lending sufficiently to the middle class, to homeowners, to small businesses. And the third is that they've been lobbying against financial regulatory reform. And in fact, in the first 3 quarters of 2009, the financial sector spent $344 million lobbying. They have First Amendment rights to lobby. It just strikes a lot of people as wrong that firms that are being subsidized by the government using taxpayer money, not just to lobby but to pay themselves well, which leads to, I guess, the solution or the alternative that the road we did not go down. You could call it nationalization or you could call it receivership. Alan Greenspan had endorsed it a year ago. Lindsey Graham endorsed it a year ago. Certainly Ben Bernanke and Timothy Geithner did not. There have been some economists on the left, Joseph Stiglitz and Paul Krugman, were endorsing this type of a solution to the bank crisis. It would seem to me that that might have been the only alternative that would have given the government the ability to clean out the banks. All kinds of research suggests when you want to turn a business or an industry around that's been failing, rule number one should be to clear out management that has failed. If you clear out management and put new management in, the new management will have every incentive to accurately report their losses right away. Blame it on the previous guy. Makes you look good in the future. You don't clear out new management, old management, and put new management in, and that old management, that existing management, is going to want to hide the losses forever. And this is part of the problem, is that losses have not actually been reported, and the banks still have this albatross around their necks. It would have also, going the receivership route, of course, given the government the practical ability to limit huge bonuses, to prevent taxpayer money from being used for lobbying, and perhaps even to start the wheels of credit expansion, restart credit expansion to homeowners, to small businesses, to the middle class. When we look at comparative and historical examples, in the 1990s, there was a bubble that burst, a real estate bubble that burst in Sweden. They have far less number of banks in Sweden, but the banks they had went under, basically, and the solution of the Swedish government was to put those banks into receivership, clean them out, take complete control of those banks, and once they cleaned them out, got them solvent again, just a few years later they were able to privatize them. I would also suggest that